Friends, welcome to the class 13 of our basics of loan assessment. We are covering the part 2 today. In the last class 12, we have discussed about the income side approach, balance sheet side approach, and the combination of both the sides for our loan assessment. In the now part second, we will discuss what all other things are checked by the banks for finalizing their loan decision besides that we have already studied in the part 1. So, what are all other factors that are studied by the banks besides the financial angles? So, what are they? The first and foremost is the comfort on the promoters. This is the very important thing when you decide whether to give loan or not to the borrower, whether to invest in his business or not. If the promoters are very good, they are having very good knowledge, very good experience, very good qualification, very good market reputation, very good feedback in the market, then many things you can ignore in your assessment in balance sheets or profit and loss account, because the promoters are very good. They are capable enough to handle any type of situation, to run the business smoothly, to come out of any situation. So that is the call on the promoter that I personally take a lot when I ever decide on the sanctioning of the loan. So promoter comfort is foremost thing. Then there is the comfort on the industry. When you give the loan, you are funding an industry, whether it is a food industry, whether it is auto parts industry, cycle industry, garment industry. So you need to have the knowledge of the full industry. If you are giving loan to an industry which is a very risky nowadays, like for example, plastic industry is very risky because governments are slowly banning the plastic products and introducing the alternative products in the market. So if the industry is not so much comfortable, then even if their balance sheets, even if their income is comfortable, you may not be able to proceed with your loan, since the industry is very, very risky. Like real estate industry is very, very risky, right? Politicians are very, very considered very, very risky because due to their media handles. So industry that you are funding in is very much impact the loan decision of yours. Third thing is the unit setup. The balance sheet, I have already told in the previous video that it may be window dressed, it may not be reflecting true picture of the borrower. So when you visit the unit of the borrower, when you visit the actual manufacturing setup, then you see a lot of working, then you see the stocks, then you see the building quality, then you see the machinery quality, then you come to know the actual investments done by the business, actual working capacity of the business, actual practical working in the premises. So you drive a lot of comfort on the unit visit. You meet the promoters and you drive the comfort from the promoters as well. So unit visit, if unit setup is very, very good, in very, very good location and in very, very good area, then you may decide the loan in favor of the borrower. Then market feedback that I have already told in the promoter comfort level. Then if you take the market feedback of the borrower and market feedback is coming very good, that borrower is very reputed, he is paying all his dues to the creditors in times, his debtors are very good, his parties are very good. If the market feedback of the borrower is very good, then it also impacts your decision. You have to take the market feedback of the borrower, but I would suggest that you don't simply base your loan decision on the market feedback only. You have to 360-degree, you have to assess the borrower on 360-degree level, not only on the market feedback, because the market feedback can never be trustworthy, because no one in the market actually knows the true picture of the borrower. Like I will give you a personal example. In one of my distant relatives, they are considered very rich amongst our relatives. We were thinking that they were very good and very rich, and they must have applied a loan in some ABC bank, and the sales team of that ABC bank knew me, so they called me up. So they told me, hey Ankush, we came to know that they are your distant relatives, so how are they worthwise? I told them that they are very good, very reputed parties, they are very rich, cash rich parties. So they told me, Ankush, but you are telling me that they are very rich, but actually they have defaulted in the 20 crore loan of a public sector bank last year. So I got too much surprised, by this that they have actually defaulted in a 20 crore loan. Then I researched about it and I came to know that they have actually defaulted there. So I was giving a positive market feedback basis what I know about them, but I didn't know about the true picture of them. So their market feedbacks can become misleading. So you do be very careful if you are trusting on the market feedback only. Then the next part is the net worth of the borrower. Once a case came up with us, the client was manufacturing a tea products. His financials were kind of below average. But when we checked the market feedback, we received his net worth certificate. We visited the client's premises and saw the title deeds of the properties. His net worth was over a 1 billion. He was having a net worth of over 1 billion and he was asking loan of only rupees 5 crore rupees from us. Only of rupees 5 crore rupees. So net worth hugely impacted our decision. That I am talking about a very practical scenario that happened to me personally. So if he is someone having a net worth of 1 billion and asking for a loan of only rupees 5 crore rupees, and his balance sheet was less than average, but his business setup was also decent. But that much of net worth, if he has generated from his business, that means he is something. He is doing something that we cannot judge from the books of account. So this can impact your decision in a big way. But be cautious. When you trust on net worth, you need to be very, very sure that it is the actual net worth of the borrower. Then comes the next part. It is the vintage of the borrower, how much experience that he has. I personally pay a very good, favor to those who have survived the COVID times. If someone has gone through to the tough times like COVID and has, has managed his business in that time and now expanding his businesses further and have already crossed the pre-COVID levels of turnover, and then I personally say that these are the very good promoters who can survive. If they have survived the COVID period without any past delinquencies in their CIBIL reports about the in COVID, then they are something. They can handle the business. They are experienced. So I give a very huge amount of importance to this, but not too much importance that I solely decide loan on basis of that, but a good amount of importance is given to that. So vintage of the client tells us how much experienced he is. The market is going up and down after every 5 years, 10 years, and he is going through every cycle of the market and still running the businesses successfully in that period. So if he has survived from last 30 years in all the market types, then he may probably survive for next 10 years also, for which I am giving the loan, right? So the vintage plays an important part. The next is the conduct of the borrower. How he is having conduct with his supplier. How is he making repayments to them? How is his conduct with his bankers? In his banking, how much cash he is generating in his business? How much check bouncings are there? How much limit is utilized? How many EMIs are bounced? How many EMIs are repaid on the time? Overall conduct of the borrower, practically judged from the banking and CIBIL report, tells us the true picture about the client's worth, how much he is focused on his business, how much he values his business, how much he values the investors in his business. So the conduct is another important aspect that we do in assessment of our lending or investment decision. Then the next part is obviously the collateral. Collateral is our fallback plan. Whenever the borrower goes NPA, non-performing asset, becomes a non-performing asset, he is not able to repay our loan, then this is our fallback plan. This is the thing that we use to recover our loan. This is the property basically that we go and sell in the market to recover our loan. If the collateral is very, very good, then we may ignore some of the factors and give borrower benefit of doubt to sanctioning the loan. In some of the cases that came across to me practically, borrower financials conduct was a bit average. Some bouncings and check bouncings here and there. Financials was decent. Market reputation was okay. Unit setup was okay. But I was giving 1 crore rupees loan and he was giving me 8 crore rupees residential property that was located in a posh area of Ludhiana. That is also मतलब that property was a cornered property with street on two sides that of 40 to 50 feet wide. 40 to 50 feet wide. What can I say here? My fallback plan is too much secured. Even if the borrower defaults in the loan, which he may not be likely, because he may not want to lose the 8 crore rupees property for defaulting just 1 crore rupees loan. That is also one additional good thing if the good collateral comes to us. So 8 crore rupees property value, if even if he defaults in 1 crore rupees loan, I can easily go and sell the property in the market for 3 crore, say 4 crore. On conservative side, buyer can easily buy this property from me for 3 or 4 crore rupees, because he is getting a heavily discounted property from me. I can easily recover my loan from there. So if a property value collateral is too much good and value is too much good, then it may be, a very good factor that can impact our lending decision, right? So overall, the call is calculated. A 360-degree view of the borrower need to be taken basis his eligibility, whether he is fit as per MPBF norms or FOIR based norms, whether his financial scoring is okay or not, financials are decent or not, whether business with respect to industry, etc., is good or not, buyer suppliers also, promoters are good or not, collateral is good or not, conduct is good or not. These are the six critical factors that impact our lending decision. So in the coming series, we are focusing on each of these factors to understand how to assess a borrower, how to finalize our lending or investment decision. Thank you for watching. Meet you in the next video. Thank you very much.